Kalispera Anthropos, welcome everybody to O Economica, all about economics and finance, and it's a quick update for me. I do it live. I will upload also some brief videos. So I have been reading through the budget documents. They are, of course, very interesting, etc., etc., etc. But there are a few inconsistencies in the OBR data tables. But before the OBR, I want to give you some good news, because the bond market has been reacting pretty well to the budget, and logically is the logical reaction that bond investor should have in this market environment. Why? For which reason? Because the data, UK inflation data, they are decreasing slowly, and I'm pretty much I'm sure that here, if we take the 10-year gilts, 10-year bond, we see that now it's pricing 4.42%. Okay, to just make it simple and quick and concise. So the bond is pricing 4.42. Okay, CPI is 3.6. So it means that there is some term premium, some risk premium in the yield curve, which is way above the current rate of inflation. And because I did my econometrics model, I did my own forecast, I do know that inflation, as well as pension funds or the investment managers, bond managers, and people who deal with the real big money, they know that inflation, UK inflation, in next, let's say 6, 12 months, 18 months, eventually will have to slowly decrease, at least the data, the headline inflation rate. If this month is 3.6, then eventually between the first quarter and the second quarter of 2026, it will gradually decrease to 3.5, 3.4. So my expectations for the modeling that I did, it will be for a CPI around 3.5%. RPI tendentially is a bit higher, but the broader inflation measures, whether it's CPI or core CPI or CPIH, core CPIH, those inflation measures will be in a range between 3.5% and 3% for next year. What that means is that in the 10-year bond and in the 30-year bond, in the 20-year gilt, 30-year gilt, there is at least, if we see what is the mark-to-market yield now, what is the market yield now, there is at least 100 basis point premium, inflation premium, which will compress, because inflation will decrease going forward, and so the inflation premium of the yield curve will have to compress. What that means is that when the 10-year gilt, potentially, it should be priced here 100 basis point lower, 3.5%. Okay, that's what I'm saying. So the yield should decrease by 100 basis points. Not should, I'm sure. I give you live a guarantee. It's guaranteed. Okay, I'm laughing, but I'm totally convinced that there is at least 100 basis points of inflation premium in the yield curve that will have to compress, because when you have a 10-year bond which is discounting at 3.5%, 3.6% inflation rate for 10 years, I think it's logically priced, is properly priced for the inflation rate that you have in the economy. So in simple terms, very, very simple. So the main takeaway is that the trade for what is pound assets or sterling assets, to me, it's to be long bonds, because there is this 100 points at least of inflation premium which is priced in the yield curve, and I see all the hallmarks that this yield will start to shrink down to 3.5%, 3.6%, to this area. So the yield will go down, the cost of borrowing will go down. That means that the value, the face value of the bond will increase. Okay, so if we take simply the zero coupon, okay, let's say it's issued at par. I'm sorry if I stumble from time to time. So if we discount it for the market yield now, no, sorry, I made a mistake. Okay, it's not 0.8, it's 4.4, sorry, 442, okay. Oh dear, sorry about that. I mean, 1 plus 0.0442, okay. So the zero coupon, it's £95.76, okay. Sorry for, I apologize for the the lengthy. If I discount it for 3.5% yield, then it's 96.60, okay. So the zero coupon at this yield, 4.4, the price is £95.70. The zero coupon at 3.5%, the bond value, it's £96. So if I do minus 95.7, okay, which is the value of the bond with the yield of 4.42%, then you see that the value of the bond with the 3.5%, with the 100 basis point rally or compression in the term premia of the yield, you see that the bond price gains 92 cents. Okay, so what I'm saying is that this market dynamic, for those who understand it, although I'm crap and explaining it, is that being long bonds or locking in these rates now and the coupons, I think is the best trade that any fund manager can do going forward, because this yield premium will have to compress at least for 2026 or 2027, and the 3.5% 10-year yield, or if we take the 30-year, the term premium, it's even wider. The market yield is 5.2%, and we see how today the yield has been compressing. So bond market, it has been rallying. Okay, it has loaded. So you see here how there is a huge gap. There is 100 basis points even here, maybe 120 basis points if the market would price a 30-year yield at 4%. What that means is that 4%, 5% it's reasonable. 4% would be, for example, would be 1.5 GDP growth and 2.5% CPI. So you will price 4%. So I would tendentially say that the 30-year yield would be 1.5 growth plus 3% inflation, 4.5%, the market yield. But still it's from here 5.2 yield to 4.5% here, this area here, around this area, series 70 basis points of decreasing, of shrinking of the inflation premia, or the risk premia of the yield curve. And that means that the value, the face value of the bond will appreciate. That means that you make capital gains on investing on the sovereign debt, and there is no more secure investment that anyone could do. It can be UK bonds, can be German bonds, US treasuries, but I see that the market opportunity somehow it has been creating here. And the shape of the yield curve, you see here that the 1 year, the 52 weeks, is 3.73. So it means that the market, the rates market, it's already pricing that the Bank of England will set the bank rate at 3 3/4 or 3.75%. So the good thing is that the bond market, it has been rallying, because it can be today it has been rallying, so the fiscal policy it's good, okay, but they take stock also of the data, of the inflation data. Inflation went from 3.8 to 3.6, and they know that will be probably 3.6, and then slowly it will step down 3.5, 3.4. Step by step, the headline CPI or core inflation rate will be in a range between 3.5 and 3%, because those are the historical average rates of inflation in the UK for the past 3 or 4 decades. Okay, so they know that the yield is going to compress, so the cost of borrowing is going to relieve the fiscal policy, because in the budget documents they say that they have 12 billion additional cost for what is fiscal policy. But here comes the painful stuff, because these tables here, they are totally inconsistent, and that scares me. Not it scares me, but I find it unconceivable that in an official document, I don't want to do some grandstanding, because also if you go and read the Minister of Finance documents for the budget, even for the Italian government or the French government, they probably they plug in some numbers just to fill the tables. So these are inconsistent, and I'm sorry that I have to say this, but it's actually in the arithmetic. Okay, so here it's all my calculus, which is not so difficult. Okay, so what that means here, we have these are OBR forecast, and I am just reading the government document. I'm not reading the OBR document, because I have the data from the ONS, and I will produce my own study. I will do my own study for me, and probably I will do some more content. So here we have government net borrowing 2025, 26, so the fiscal year up to 2030, 31, and primary deficit. If I can cancel this thing, primary deficit, so we will see it together again. Very easy, I will do it again. Okay, so from this table, if you are anywhere in the UK or anywhere in the world, from this table you can easily understand what is the implied tax take of the government. Okay, so here we have current budget 1.7, investment 2.8, so the sum is 4.5. And so they add this string here and they say public sector net borrowing 4.5. Then another row here and say, okay, net borrowing is 4.5% of GDP. Then the overall government borrowing is 5%. Okay, and the primary deficit is 1.5. So the 5 minus 1.5 equals 3.5. So what that means is that the 3.5% that is missing between these two numbers is the actual tax revenue of the government. So with this table, you are able to know what they are projecting are the tax revenue. And this 3.5%, it's consistent for 3 fiscal years. 5, 1.5 is 3.5. 4.1, 0.6. In my mathematical world, is 3.5. 3.6 and 0.1 is 3.5. Now here, in these 2 fiscal years, which are long in the future, 28, 29, 29, 2030, oh my god, it's 3.7. So the revenue of the government is 3.7, because the gap between the borrowing and the deficit, not the gap. So yes, yeah. I don't know how can I explain. So all the borrowing is 5, okay, but the deficit is 1.5. So that means that they require 5% this year. They can meet by tax revenue 3.5%. Okay, so and the deficit it's 1.5%. So they borrow 1.5% of GDP, and 3.5% of GDP is tax revenue. That's how it's the structure. Okay. Here you see it's 3.7 because 3.2 and minus 0.5, it means that they project that it's a fiscal surplus of 0.5 percentage point. 29, 2030, they project 1.3 negative deficit. Because these are 2 negatives, it's a surplus. Then 2030-31, it's 3.8, the difference between these 2 numbers. And the difference is the revenue, the tax revenue that they cover with government revenue. And the deficit or the surplus, it's the additional borrowing or fiscal surplus. Okay, so if we see the progression here, they assume that the tax intake is 3.5% steady up to 27-28 fiscal year. Then the tax revenue grows to 3.7 and then 3.8. Okay, reasonable. What it doesn't really is here the cyclically adjust primary deficit. It's a technical term to describe the primary deficit without the cyclical factors, which is the what are the variable data that they get into the economy. You know, there are some structural things and some cyclical things which can be more volatile in GDP or inflation and all the other things. And so the cyclically adjust primary deficit accounts also for the volatile stuff. Here we see that the cyclically adjust primary deficit, it shrinks a little bit more here than the primary deficit. But this data table pretty much is it's okay. It makes sense. But here, it doesn't. It starts not to make sense. We will see. Okay, so first of all, they have the wrong numbers. So they have unemployment rate 4.8%, which is not 4.8%, it's 5%. So it's the wrong data. It's the wrong data. Indicators. Unemployment in the UK, and they are all moaning about unemployment. It's every day they are complaining about unemployment. Okay, unemployment, United Kingdom indicators. Unemployment rate, it's 5%. And in the previous month or quarter was 4.8%. How can you, okay, 4.8, so that's the old data. Okay, inflation, it's wrong, it's the wrong data, 3.5, no. So if they have, inflation was 3.8, if they take this, the previous unemployment rate, 4.8, the previous inflation rate was 3.8, now it's 3.6, CPI is not 3.5, at least for, according to this table, then I may be wrong. But the projections, they are totally inconsistent. They are really inconsistent. I'm bewildered. I'm really bewildered. Because unemployment is 5%. And 2026, they project 4.9, so the projection is wrong. And I can tell you that unemployment already now, it's already for certain measures, it's 5.2%. But what they got totally wrong is that then unemployment will go to 4.1%. That's bonkers. That's totally bonkers. It's totally bonkers. Really, it's totally bonkers. And the proof that these numbers, they are totally bonkers, see what does the inflation rate. 2025, 3.5. Next year, 2.5. A jump of 1% from where you find, and you see that 27, 28, 29, 30, 2%, 2%. Yeah, you just chuck a 2 and fill up the 4. That's it. That's the OBR. And so, in an official document, you plug in this kind of stuff. I'm really bewildered. Honestly, I'm bewildered. And the fact that the deficit shrinks, I mean, I'm not against the UK government or anything. And I'm happy, I'm glad that the bond market, it has responded well. And what I'm saying is that the cost of borrowing will compress, will shrink. So there will be relief on fiscal policy from the cost of borrowing. The gilts market will come down, for sure, the yield curve will settle to lower cost of borrowing. But the data, they are inconsistent. I cannot make it up, honestly. Because the deficit here, what becomes a fiscal surplus of 0.5, 1.3, 1.4, these are not really consistent with the GDP data here, the projected data, because here, honestly, this other OBR table, it's bonkers. Because you see 2% inflation, 4 times 2%. Also, GDP, 1.5. Yeah, come on. Are you fucking kidding me? Come on. This is really, it's bonkers. And what that means is that they know, because these are past data. You see here how to read the data. GDP in 2024 was 1.1. Potential 1.6. Okay, so here there is a gap of minus 0.5. Okay, what that means is a negative output gap. It means that GDP, the gross domestic product, it grows less than what is the potential of the economy. And so it's a negative output gap, which is consistent with what? With the unemployment rate rising to 5%. Because the economy has potential, but the gap is negative. There is more unemployment. Okay? It's natural to understand. What they see here, that potential for 2025, it's 1.8. Then it depends how they calculate potential output. No comment. And here, GDP for this year, it's 1.5. I tell you now that it's not 1.5, it's 1.3. So I think they are projecting the wrong data. If it's 1.5, all the better, even better. But GDP year on year, it's 1.3. So I don't know from where they get this data. I have no idea, honestly. But anyway, 2026, 2027, the economy grows 1.4, 1.5, and potential GDP it's 1.3. So the output gap, the economy, the real economy grows more than the potential of the economy. Okay, so you have a positive output gap, which is good. When you have a positive output gap, then it's it's conducive, so it leads you into doing less debt. It means that GDP grows more than that, and you can justify a fiscal surplus. Okay, but here 1.4 over 1.3, the positive output gap is 0.1 plus 0.1, and here 1.5, 1.3, it's plus 0.2. Okay, and if we see the following years, 29 and 30, 1.5, 1.5, GDP and potential, so the economy grows at potential. So the positive output gap is for 2 years, 0.1, 0.2. How that basically translates into these sorts of shrinking of primary deficit, minus 0.5, minus 1%. How can you, if you have a positive output gap of 0.1 slash 0.2 for 2 years, and then the economy grows at potential, how can you have a fiscal surplus of 1.4%? Okay, so these two data, they are inconsistent, and they are basically, they are the derivation they derived from bonkers data here. 2% inflation, unemployment that goes to 4%. And what confirms the fact that the OBR projection, they are totally bonkers. I'm sorry. Okay, they are totally bonkers. Because the primary surplus that comes here, the negative deficit, so 2 minus make a plus, so they project a huge fiscal surplus. It can be justifiable because the intakes of tax grows from 3.5, then goes to 3.7, then 3.8, okay? But these are totally inconsistent here, because you need to look at this. General government investment. So how on earth you have general government investment 7.8% in 2026, 5.4% in 2027. What that means that the government is planning to invest 7.8% of GDP or 5.4% of GDP, or those are the main components. It's planning to invest huge amounts. So it means that the fiscal requirements, so the borrowing requirements, will grow exponentially, not exponentially, will more than double, because 2025 government investment 2.5%. Next year 7.8%. Okay, these are China numbers. It's like the Chinese economy that they do 8 to 10% government investment every year. So what do you expect? That the borrowing requirements to grow. So how can you reconcile to have a fiscal surplus down the line into 27, 28, 29 with this kind of investment figures? I'm not saying that they should not do investments, but 7.8%, 5.4%, these are large sums, tens of billions, hundreds of billions of pounds. So if that requirement expands a lot, I don't see how it's consistent with the fiscal surplus down the line. Here, the primary deficit becomes negative. It means that you are even able, you want to borrow 5, 7.8 or 5.4 to do government investment, okay? And at the same time, you are even able to make a fiscal surplus. It's totally inconsistent. Totally inconsistent. And only by checking these numbers, they plug CPI 2%, 2, or 1.5, 1.5. It's totally bonkers. They make no sense. And another thing here, here, where is household consumption? Okay, it's projected to increase a little bit, but business investment, okay, so let's do another thinking, okay, let's see if it makes sense. To me, there is no logic. Business investment 2.3, 2.8%, 2025. Then it's negative next year, 0.6, 0.9. It's not, you have more government investment, 7.8, 5.4%. But business investment is projected to be not so buoyant, okay? How on earth you pretend that the unemployment rate is going to shrink to 4.1% with this kind of business investment? There is only one answer. Everybody's going to work for the government. But you know how many millions of people they have to be employed by the government from government investment? I mean, that's why I said I'm a bit bewildered. I'm laughing, I'm joking, but I did not expect to find this level of inconsistency and just see the CPI number 2%, 2%, 2%, 2%. They are not able to make a forecast, but because a 5-year forward forecast of headline inflation, you cannot do it. So they just plug in the numbers like that. Okay. But the unemployment rate going at 4.1, shrinking at 4.1%, from where all these jobs are gonna come from? I have no clue. I have no idea. And then why, if you have unemployment at 4.2%, 4.3%, why GDP it's only 1.5% for 4 years in a row? You know, the data tables they are totally inconsistent. And here these government investment numbers here, they do not reconcile, they are not consistent with the fiscal surplus here. Here, primary deficit shrinking. It's not possible. It's not possible. It's not possible. So, I mean, the only good news is that the bond market is gonna rally. But these data tables, they are totally bonkers, honestly. And I'm bewildered. I don't need to say any more. No, I'm gonna shut the live now. And I thank you all that if anyone has listened, I upload some short videos. what can I say? Good news is that the bond market, it has rallied, but the OBR data here, they are really inconsistent, and no problem. So thanks a lot. I will go back to things that I have to do, and I'll see you next time.